Welcome to another insightful session with Informed Investor. If you've been keeping an eye on your portfolio or the broader markets, you've probably noticed it's been a roller coaster ride. Our markets have declined significantly, the worst in the last 29 years, wiping more than 85 lakh crore, approximately 1 trillion of investor wealth. At this point, many and many more start to wonder, have we entered a bear market? Why are the markets falling? Will the markets even recover? Should you hold, rebalance, or seek new opportunity? How should you look at your portfolio? These questions are on everyone's mind, and today we're here to address them head on. In this video, we'll break down why the markets are falling, the key reasons behind this crash. We'll analyze the current state of the Indian economy and whether this downturn is a short-term panic or a long-term trend. Most importantly, we'll discuss strategies and how to invest during a market crash, because as history has shown, downturns can often present the best investment opportunities. So stay with us till the end, because this session will help you navigate the uncertainty and make informed investment decisions. Let's begin to watching Informed Investor, an initiative of Equentis. First things first, let's understand the current market crash. India stock markets have been on a 5-month losing streak, basically 5 months of consecutive losses. And historically, such prolonged corrections have been very rare. The last time Nifty fell for 5 consecutive months was 28 years ago in July 1996 to November 1996, declining by 26%. The longest consecutive losses that Nifty has ever seen was back in September 1994 to April 1995, that saw the markets decline for 8 months, dropping 31.4%. Now the current drawdown of 15.5%, though significant, remains milder in comparison to the other drawdowns. And if you compare India's performance against other global markets, Nifty and Sensex have declined the most, while Hang Seng and DAX, representing Hong Kong and Germany respectively, witnessed the highest gains since September end. Meanwhile, the broader and the more domestically focused mid-cap index technically entered a bear market, falling more than 20% from the September high. Even equity mutual funds have seen a considerable decline, with the average declines for large caps being 19%, mid caps being 21%, and small caps being the highest at 23.5%. So what's behind this downturn? Well, it's a mix of factors. First and the most significant is that foreign investors have been pulling out big money. The month of October saw FIIs pulling out more than 94,000 crores. Even 2025 has been a year of selling so far. FIIs have sold 78,000 crore in January, 34,500 crore in February, and 16,689 crore so far in the first few days of March. All this selling has amounted to 1,29,000 crores, a significant amount. With barely 3 months into 2025, FIIs have been aggressively selling, which is hurting market sentiment. This aggressive selling by foreign investors has dampened demand for Indian financial assets like equity and the rupee. The Indian rupee has been under immense pressure due to various economic factors. And to help the weakening rupee, the RBI intervened twice and sold almost $2.5 to $3 billion to support the weakening rupee. Additionally, in January 2025, India's merchandise trade deficit surged to $22.99 billion, exceeding expectations. A weak rupee makes imports more expensive, which can further intensify the trade deficit and negatively impact the economy. This economic instability contributes to investor skepticism and market volatility. Thirdly, the recent announcement by US President Donald Trump regarding reciprocal tariffs have added to the uncertainty in global markets, including India. In fact, on Tuesday, 4th March 2025, Trump has already imposed tariffs on major trading partners like Mexico and Canada with 25% of tariffs, and doubled the tax on Chinese imports from 10 to 20%. Following this, China and Canada have immediately retaliated with tariffs on US imports, creating trade wars between these countries. And Trump hasn't stopped there. Trump pledges to announce reciprocal taxes for India from 2nd April, creating uncertainty. This geopolitical tension and trade uncertainty are causing investors to become cautious, leading to a decline in market sentiment. The fear of a broader trade war is also impacting investor confidence globally, affecting India indirectly. The third quarter earnings for fiscal year 25 displayed a slight slowdown, with weak revenue growth as seen from a sample size of 1,899 companies. But if you look at the performance from companies in key indexes, revenue growth of companies in the Nifty 50 slowed to a 16-quarter low to 4.5% growth, while revenue slowed to a 5-quarter low of 4.6% for Nifty 500 companies. This led to downgrades and a sell-off, particularly in the mid-cap and small-cap stocks, which have seen significant declines since the start of the year. Disappointing earning reports often lead to reduced investor confidence, contributing to market declines. Lastly, since the resurgence of the Trump administration, the US equity and bond markets have been drawing significant capital inflows from across the globe. Rising US bond yields can make US investments more attractive compared to emerging markets like India, leading to capital outflows. Additionally, China has become an attractive destination for portfolio flows on the back of its economy stabilizing, which included rate cuts, property sector support, and liquidity injections, all of which have attracted investors. The narrative "Sell India, Buy China" is gaining popularity among foreign investors. In summary, the interplay of global uncertainty, geopolitical tensions, and domestic challenges have made investors cautious, leading to a prolonged decline in the Indian markets, making this one of the longest declines in Indian history. So what's next? Firstly, let's get one thing straight. Market corrections are a natural part of the economic cycle. They might feel unsettling, but they're essential for resetting valuations and creating opportunities. Now, when we talk about corrections, there are two main types to consider: price corrections and valuation corrections. Price corrections refer to a drop in stock prices due to macroeconomic factors or market sentiment. On the other hand, valuation corrections occur when company earnings grow even as prices decline, making stocks more attractive in terms of their intrinsic value. Now, here's the kicker. Currently, the Nifty's price to earnings ratio trades at 19.6 times below the critical 20 level and well below its median of 22.7. When the P ratio is lower than average, it often indicates that stocks are undervalued, making them attractive for long-term investors. The last time Nifty's trailing P was below 20 was 32 months ago. And if you see, the Nifty P dipped below 20 level only twice in the last 5 years during two major events. First was in the aftermath of the Russia-Ukraine war, when it fell to 18.92 between May and July 2022. And the second time it fell below 20 was during COVID, when it reached a low of 17.2. Now, what does history tell us? Historically, Nifty 50 has experienced 11 corrections exceeding 15%. Currently, we are seeing a correction of 15.8%, which has lasted for 5 consecutive months, a rare occurrence. And in 5 of these corrections, valuations corrections were deeper than price corrections. This means company earnings grew even as stock prices dropped, creating solid investment opportunities. Now, what is the takeaway? Corrections take time, but recovery always comes. The market has never failed to bounce back. So rather than panicking, focus on valuations and long-term opportunities. Now, apart from that, there are several positive triggers on the horizon that could boost the Indian economy and by extension, the markets as well. First is a focus on the revival of consumption. The last few years, we have seen a slowdown in private consumption and most of the market returns came from the government-led capex. However, now we are seeing signs of a consumption recovery actively supported by both the government and the RBI. The Reserve Bank of India has been keeping a close eye on inflation and economic growth. And in line with this, it started embarking on monetary policy easing and cut interest rates by 25 basis points to 6.25% in the February meeting. Going ahead, analysts expect the RBI to further cut rates in the upcoming meeting in April by another 25 basis points. Lower interest rates make borrowing cheaper, which can stimulate the economic growth by encouraging businesses to invest and consumers to spend, thereby supporting consumption. This could be a significant boost to the economy, especially during times of market volatility. Along with that, the government made a mega announcement in the Union Budget of 2025. By announcing the large tax relief, the government is foregoing 1 lakh crore in direct tax revenue. This thereby puts 1 lakh crore more money in people's hands, boosting spending, savings, and investing, which are key drivers of economic growth. By easing the tax burden, the government is strengthening India's consumer-driven economy while simplifying the system and building confidence. The other two factors are the health of balance sheets of both financial institutions in the country as well as those of the government. A way to track government's finances is to look at the fiscal deficit. Fiscal deficit represents the amount the government borrows to cover expenses beyond the income it generates. This amount is expressed as a percentage of GDP. And if you see the image, after the enormous spending due to COVID, fiscal deficit reached 9.2%. But since then, the deficit has been gradually declining. Looking ahead, the Union government sets an ambitious target of achieving a fiscal deficit of 4.4% for fiscal year 26. At the end of it, reducing the fiscal deficit strengthens the government's financial position, leading to lower borrowing costs and freeing up resources. This allows for increased flexibility to inject liquidity into the economy during downturns, stimulating growth without excessive debt accumulation. Now, lastly, banks are also sitting on healthy balance sheet. One of the key metrics to assess this is the decline in non-performing assets. If you look at the image, the decline in non-performing assets in the banking sector is a positive sign. Lower NPAs empower banks to lend more, fueling economic activity and growth. Additionally, it also ensures banks can provide vital liquidity during downturns, maintaining stability. Ultimately, this creates a resilient financial system that fosters investor confidence and supports sustained economic expansion. So while the current market conditions are challenging, there are reasons to be optimistic about the future. By focusing on these positive trends and staying informed about changing economic conditions, you can navigate market volatility more effectively. Now, before we end this, let's discuss some essential strategies for navigating a bear market. These tips may help you make informed decisions and potentially turn market downturns into opportunities. Market crashes are emotionally draining, but history has shown that patience pays. The market has always rebounded, so instead of reacting impulsively, stay focused on long-term investing. This is the time to invest in strong, fundamentally sound companies with healthy balance sheets, consistent earnings, and competitive advantages. Look at companies with low debt, strong cash flows, and high return on equity. Instead of trying to time the bottom, stick to your SIPs or STPs to stagger your investments into equity. Bear markets provide an opportunity to accumulate more units at low prices, improving long-term returns. Review your asset allocation. For instance, if your portfolio has become too heavily weighted in growth stocks, consider shifting some funds to value stocks, which may offer better opportunities during a bear market. Markets are down, but many companies' earnings are still growing. Look for stocks or sectors where valuations has corrected significantly, but fundamentals remain strong. These are the hidden gems that often deliver outsized returns in the next bull run. Dividend-paying stocks tend to be more resilient in bear markets and provide a steady income. Consider high dividend yield stocks in defensive sectors like FMCG, pharma, and utilities. Selling at a loss locks in permanent damage to your wealth. If your investment thesis remains intact, hold on and ride through the cycle. Also avoid taking excessive leverage as volatility can wipe out your capital. Bear markets impact stocks the most, but other asset classes can provide stability. Consider gold, bonds, REITs, or other international diversification to hedge risks and protect your portfolio. Bear markets don't last forever. When the tide turns, you want to be invested in the right stocks and sectors early. Historically, markets have rebounded strongly post-corrections, rewarding those who stay invested. Lastly, opportunities arise in downturn. Keep some cash ready to deploy when valuations become attractive. This way, you can capitalize on great bargains without disrupting your financial stability. Having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.